Hello, and in today's video we are looking at a stock that Warren Buffett is buying more of. We're taking a look at Occidental Petroleum. We're going to take a look at the historical prices. We're then going to take a look at exactly how much he has been buying. We're going to take a look at what the intrinsic value of this company is and whether or not when we apply a margin of safety, this is a buy right now or even a sell. So firstly, what we can take a look at is the 13F filing that he has done recently. I believe it was just yesterday or the day before. And we can see here the second largest increase in his portfolio was the purchase of 1 billion, just under 1.1 billion shares of Occidental Petroleum, coming second to his absolute favorite stock, Apple. Now, before we look into the intrinsic value, let's take a very quick look at the graph. So over the last 10 years, this stock has been trending downwards on a decrease of 32%. If we look year to date, however, this company is only down 3%, so it hasn't had much upside in recent times. Again, this really depends on where you have bought the stock. The current yield is looking at around 1%, 1.24% in fact, and it has a forward-looking PE of just under 12. And in terms of the 52-week range, it is trailing more towards the lower end of $54. Now, as I mentioned, we're going to take a look at the intrinsic value, and as I've said, 1.1 billion shares, just under of Occidental. So Warren Buffett is loving this stock. Now, the question really is this stock undervalued? Is it something we should consider in our portfolio, or is this stock something that really it's not for us, or we should be looking to sell if we have a current position in? If you enjoy these videos, smash the like button, smash the subscribe button, and let's jump straight into today's episode. So, Graham's valuation currently input the figures of the earnings per share at $12.56. The growth rate, as you've noticed here, is -1, as analysts are expecting a decrease in the growth rate over the longevity of the firm. Now, the current yield on AAA corporate bonds is 4.37, so we input these numbers, and the intrinsic value is sitting around $75.88, so that is showing some upside to the stock at the current price. Again, we never look at these models in isolation, and we like to look at all four for the majority. Now, multiples valuation, what we're doing here is we're inputting in companies in a similar industry. So we have well-known companies, we have ExxonMobil, we have Chevron and Pioneer Natural Resources. We input their current stock prices with their earnings per share, and this gives us the PE multiple. Again, here we have the average of these multiples, which we multiply by the earnings per share to give a stock price of $92.91. Now, again, this is showing that there is upside towards the current stock market price. Dividend discount, as you can see here, once we've inputted the yearly dividends, it does look a bit funny. So essentially what's happened was around 4 years ago, they cut the dividend quite significantly from just around $3.1 to 80 cents for the year. And then what they essentially did was they stopped the dividend, but they reinstated it. And as we can see here, it's slowly increasing. So obviously the average growth rate looks a bit funky. It's coming in at around 214%. So I've gone for I guess you could say a modest 8%, given the forward looking. You would expect them to start increasing their dividends quite significantly, given that they have, and we can find out in the discounted cash flow, room to basically keep growing. Now, what we have here is the value of next year dividend divided by the cost of equity less the growth rate in perpetuity, and this gives us a DDM price of $77.76. So fairly similar with Graham's model. Now, the final model, one of my favorites, the discounted cash flow model, we're inputting the free cash flow over the last 10 years. We're looking at that growth rate year on year, and as we can see here, there's been quite some variances across the years. You have negative 190%, but then on here in 2018 you have 330%. So as an average is 23.48%. So we've used in the growth rate of negative 10%. So essentially analysts are estimating that, as mentioned earlier, the free cash flow will be dropping in quite significantly. There may be some element of not expecting oil to be something that we will be using in the future. So that could also have been incorporated into that. Now, what we're essentially doing here is once we have the future free cash flows and the terminal value, we're using our discount rate to get the present value of future free cash flows. We add these together, we add the cash and cash equivalents of Occidental, we subtract the total debt, and we arrive at our equity value. We then divide this by the shares outstanding, and this arrives at our DCF price of $74.23. Now, what we have here is the stock valuation model that we've just run through with our 4 prices. As we've explained, we've run through. We can see that they're fairly similar, the Graham's discounted cash flow and the dividend discounted model around the mid-70s, with the multiples showing a higher figure. You could argue that the other companies, when we look at the multiples valuation, are trading at a higher multiple currently to Oxy. Again, what we are essentially doing here is our intrinsic value is the average of these 4, so we get $80.19. And before we look at what our current price and acceptable buy price would be, Wall Street are forecasting over the next 12 months for the price to rise to $71.59. So if we look at that compared to the current price of around $58, there is quite some significant upside according to the analyst. Again, this is all for entertainment purposes and not financial advice. Now, when we look at our margin of safety, again, before we look at that, smash the like button if you've been enjoying this content, smash the subscribe button. And I would personally like quite a significant margin of safety in a company in this industry personally. So normally while I'd look at 10%, I would be looking for around 20 to 30% at a minimum. So if someone would be looking at 20% margin of safety, your acceptable buy price would be around the low 60s. However, if you're a lot more conservative and you're looking for around 30%, your acceptable buy price would be around $56, so not far off the current trading price essentially. So let me know your thoughts in the comment. Is Occidental a company that you will be adding to, or if you're a current shareholder, do let me know your thoughts on this company. As always, have a great day and don't forget to smash that like button. Thank you.